Good afternoon, everybody, and welcome to the Kluge Wealth Advisory Group Bitcoin 101 Understanding Digital Assets webinar. Very happy to present today to you this content, and we're partnering today with Fidelity Digital Assets and Brendan Sims, who is joining us from Vancouver, although he's normally based out of Toronto. So, quick biography of Brendan here. He has been with Fidelity since 2018. He's a CPA by training and by education, but very quickly transitioned out of the public accounting world into the investment world to pursue his passion. He has been covering Fidelity's alternative assets since 2023, and we're very, very happy to have him here. I'll let Brendan give you a little bit more background himself and then launch into the presentation. And so with that, I'll turn things over to Brendan. Brendan, please grab the baton here.
Conrad, thank you very much for having me, and thank you to the rest of the team. Most importantly, thank you for taking times out of your day to tune in and learn more about digital assets and sort of our house view on them. And from the quick introduction between Conrad and myself, it would seem that we share a similar outlook towards the space, sort of learning from the history in which has unfolded over the past 16 years since Bitcoin, the first adopter or the first entrant into the digital asset space, but also from some additional sections of the digital asset space, whether that be Ethereum, Solana, XRP. This is a growing network of, I guess, technological competitors that are looking to shape and drive and provide change on a technological standpoint with how we transact, where value is stored, and methodologies in which sort of value is transferred on a global payment network scale, as well as how individuals seek to store value, not only in developed markets, in sort of North Americas, if you would, but also in rest of world. There are parts of the world which are underappreciated, where inflation is a massive concern, and these digital assets today are already driving real change with respect to providing change in people's everyday lives. So I know that there are a ton of questions here lined up in the queue. So I look forward to having a fruitful discussion here today. And Conrad, why don't we kick things off? I have some slides, but let's keep this conversational. I know we're going to bounce around a little bit on many different fronts.
Absolutely, Brendan. I think that's a great idea. I think I just wanted one quick housekeeping note that I did forget. If you have questions, please email me. We're monitoring emails, as well as I'm going to open up a Q&A feature once Brendan gets through with the slides. But if there's something that's on your mind you want to make sure we're getting to in the Q&A section, just email that over. We already have quite a few questions, and it'd be great if we got some more so we can really make this into a useful conversation here. So, Brendan, why don't you just take it away here?
Awesome. I don't use Teams every day. I think I've successfully brought my screen on board here. I do want to talk about FBTC, or Fidelity Advantage Bitcoin in particular, but we don't need to make this just about exchange traded products. We don't need to make this just about Fidelity's product. We can talk about digital assets and Bitcoin more broadly. But while on the topic, what I would say is that FBTC is a leading Canadian exchange traded solution to give investors within registered or non-reg accounts access to digital assets. And Canada was, in fact, here long before our US counterparts. We saw a lot of the noise and a lot of the media in relation to US exchange traded products coming about last January of 24. I think it's great that we were here before the US to sort of roll this product out. Fidelity has been a leader in the space with respect to the inclusion of FBTC in our all-in-one suite of funds. For those that maybe aren't not familiar, that is a factor-based, diversified, multi-asset suite of funds that we, on an auto basis, included 1 to 3% allocation to digital assets, emphasizing our house view or our constructive position. We're not here to say that every client needs to hold this. I mean, if you catch me in an elevator somewhere, we might have a different conversation. But with respect to the Fidelity house view, we think that the opportunity to incorporate alternative asset classes, be it digital assets, into portfolios is a win. And it sounds like the team is very much on board with sort of building in alternative exposures into portfolios. And it's been one that has worked quite well for investors over the last 1, 2, 3, 5 years with respect to digital asset exposures. But when we think about Bitcoin in particular, you'll have to forgive me here. I just need to make sure my slides are changing properly. We can see the next slide here now.
Yes, we can see the slide there, Brennan.
Okay, perfect.
Please
Bitcoin
continue.
in itself has come through about 16 years of history. And we have some slides that we'll get to later that talk about the maturation of Bitcoin as a phenomenon, as a technology, as an asset class. Of course, we need to look at this in some sense of a logarithmic scale to really make sense of it. A lot of the price action prior to 2017 is not even registering on such a chart. But really what we're getting at with this timeline here is the transition phases, the hurdles in which Bitcoin as a digital asset has overcome. Through the 2010s and teens, it was often the naysayers' argument that this could not be a currency because of its inability to transact due to volatility. Fast forward to today, in 2020 and onwards, we're talking about this in developed markets anyways, as more of a store of value. I hinted or alluded to nations and or areas of the world where inflation is a big concern. If your currency is inflating at such a pace that you're not maintaining your store of value, regardless of minor fluctuations in the price of the underlying, I think this is a massive value proposition for those looking to transact for everyday goods. The way it is here in 2025, I would say that Bitcoin has very much made its way from Main Street to Wall Street. And that's sort of an analogy which I use in a sense that, like, if we look at other phenomena, whether that's mortgages, other aspects of banking, a lot of financial products have been engineered on Wall Street and introduced or sold or brought to Main Street. This was sort of the first of its kind that went backwards. We saw the likes of large US banks and asset managers, the BlackRocks of the world, who were oftentimes quoted as being naysayers towards the space, really doing a 180 and transitioning their view towards digital assets. Most recently, with the current US administration, I think that they're very pro-regulation. And being pro-regulation isn't necessarily to be confused as a bad thing. In order for things to develop, advance, and grow, regulation is needed. Whereas if you just take a frictional approach like the former administration, and you're not open to even regulatory conversations, you just shut things out, things will still advance, but they'll advance in back channels. So I think that under the current administration, from a US standpoint, it's going to allow foundations for digital assets to grow and prosper. We're seeing, whether it's advancements in the stablecoin space, Bitcoin Treasury Corps, amongst others, we're seeing a lot of sort of advancements and growth in the space right now that are favorable towards the price of the underlying. Conrad, I know we talked about stock to flow models. There's some dynamics that we use to assess sort of the potential for higher prices. As new entrants come in, I just want to simplify this and strip back all the minutia. As new entrants, like pension funds, like institutional counterparts, like large US banks, take a seat at the table, with Bitcoin having a finite characteristic to it, all things being equal, that's going to place upward pressures on price. And we want to keep things simple here, but I do think that as this sort of matures, grows out, settles into, I guess, like a less volatile nature than it had previously traded with through the 2010s and teens, you're going to see this be more widespread adopted, being built into institutional style portfolios as people gain comfort with the price of the underlying. But maybe to cater to all ends of the audience on this call, I think we need to strip back and sort of assess what is Bitcoin and what are digital assets broadly, what is their value proposition. So it's a decentralized technology using blockchain technology to provide a store of value. And that's really what it was at its basis 16 years ago, and that's what it sits at today. There is a degree of tradability, scarcity, amongst others. We could get into the whole aspect of a finite supply of 21 million coins. Today, Google would give you a more accurate answer. At a time, it was about 19.8 million had been mined and or in existence today. I think that the relationship in which we approach that 21 million coins, it's using a fancy word, it's asymptotic, which essentially in everyday speak just means the rate at which we approach that finite supply is going to get very, very slow. We will get there. It'll take about 120 years. But compared to fiat or compared to dollars, whether that's the CAD or the USD, there is not an unlimited printable amount of money out there with respect to Bitcoin. And I think that that's a really good thing. We can draw parallels from Bitcoin to gold in that respect. The market cap for gold at a point in time, and forgive me, gold has gone on quite the run recently, but at a time recently, it was about 20 trillion in size, with Bitcoin at about 2 trillion in size. So we can make the inference that Bitcoin is about 10% of the value of gold in today's present dollar terms. But we want to compare and we want to gain an understanding of Bitcoin, its value propositions related to sort of fiat or everyday paper money, and then compare that to gold. And we could spend a whole session and sort of write a paper on why these are what they are. But I think the main message to take away from this slide is that there's a value proposition to be had for Bitcoin in relation to those other sort of stores of value that we make reference to. It was 1970 or 1971 that the gold standard was abolished. If anyone can hold me accountable to that, feel free. And we've seen a massive sort of disconnect in the stability of the price of gold when the US abandoned the US dollar's peg to the price of gold. We saw gold do quite well. An interesting stat actually about gold and its importance are actually, well, I'm sitting on this slide, I'll just maybe move forward one. I read it the other day. If you bought gold in 1980, 45 years ago, you just broke even on a real return basis relative to inflation, meaning your real return just went positive. And that speaks to timing really matters. In contrast, if you bought gold in 2020, relative to say so if you bought the S&P 500 in 1980, 45 years ago, you would have realized a 2,450% return over that time. And meanwhile, with gold, you just broke even on an inflation-adjusted basis. So the message here is that timing matters. If you made that same transaction comparison in 2020, gold would have materially outstripped the S&P 500 and provided materially positive real returns. So I think that timing matters, and that brings me to a slide that I'm going to jump forward to here. It just has a few different kind of macroeconomic type facts or stats that I'm going to speak to. The US currently has about 37 trillion of outstanding debt. And I think that's an alarming number. We could do a whole session on sort of breaking that down, what's alarming about it. Some of the stats we've heard most recently are that the interest expense or their cost on outstanding debt now exceeds their entire military budget. So red flags across the board with respect to some of these observations. I think that under today's macro backdrop, the playbook from a year to 2 years ago is seemingly coming to fruition. The probability of the need to inflate away this 37 trillion, and in everyday speak, that essentially means just run the economy hot, run high GDP prints, run the economy hot, and make 37 trillion seemingly a less mountainous hurdle to pay back than it once did seem. That's to say, increase the tax base that you're sort of taxing on. Historically, limited times that the government has run at a surplus have been when the stock market was at its hottest and highest levels. So that's to say that the government likes collecting capital gains from those that hold appreciating assets and then trigger dispositions. So needless to say, there is a real macro backdrop to suggest that real assets, whether that's gold, Bitcoin, housing, real estate, farmland, you name it, are standing to get caught in the crosshairs of what could be very stimulus policy going forward. We've long seen Trump talking about, call it pulling down the front end of the curve. We could list off on almost one or two hands the number of names in which he's called Fed Chair Jay Powell with respect to his inability to sort of get it right and pull down the front end of the curve. But if I look at the composition of that $37 trillion, I think that, and I think about, it's not just the front end of the curve that the US has issued debt on. So if they pull down the front end, what happens to the long end? What happens to 30-year treasuries or 30-year bonds, 10-year treasuries or notes for that matter? I think that the long end of the curve or the bond market's not going to like it if they pull down the short end or make money cheap. And what's going to happen is they're going to need to reinitiate quantitative easing or some sort of stimulus. And all things being equal, that's what brings us to that green line, M2, or the money supply. As you introduce more money into the system, it naturally wants to find a home. There's already $7 trillion in money market assets in the US, a historically high number. And I think that as we talk about more money looking to find a home, we saw that in 2021, 22, when money became cheap. We saw what real estate did, and we also subsequently have seen what it does when you take that punch bowl away, if you would, or rates have been higher for longer. So I'm kind of I've been belaboring this, but I think the main message is there is a monetary fiscal concoction at play here that suggests that this is a very nice outlook for real assets, should any form of what I just discussed kind of play through. But with that said, I've been talking a lot. I'm going to catch a breath. Conrad, were there any questions from the group?
Yeah. So, I mean, Brendan, thanks for sharing that viewpoint there. That look like at the end of the day, Bitcoin, in addition to the, what we sort of term the network effects, which is how many people are connected. There's also the argument that it's a scarce asset that's in demand from both individuals as well as institutions, and that there's obviously that will create value. I think one of the questions we are getting here is just maybe just take a step backwards and explain like what a blockchain is and what makes a Bitcoin different from other blockchains that people may have heard of, like Ethereum or like Solana. And maybe just like a quick, very basic, how you would differentiate those big blockchains from each other, and in fact, just starting with what a blockchain is.
Okay, and I will do my absolute best to play both sides of the coin, but I'm very much inclined to talk about this in everyday speak because I do not have a computer science background.
Please do. I'm very much of the mind that if we can't explain, I hold myself to the standard. If I can't explain it in grade 4 English, then I don't understand it.
Yeah, I started my career in accounting. I've worked in finance for 7-8 years now. So I understand this somewhat at an everyday fundamental level. But I think that if we think about the Bitcoin network or the blockchain network that supports Bitcoin, it utilizes a proof of work methodology, which essentially means that they're in a decentralized fashion. Let's just say that there's 10 computers located globally. And those 10 computers are relatively powerful. They've been bought intentionally with high computing power to support this network. They are solving what we'd call cryptographic puzzles. Essentially, there are long phrases, alphanumeric, in which identify and provide this network that is the blockchain that is fully unique and identifiable. So they are essentially problem solving around the clock to provide support to what is an unbreakable level of sort of encryption to this network to allow peers to send and transact dollars, or not, I shouldn't say dollars, that was actually a misstep, value through the unit that is one Bitcoin or a fraction of Bitcoin from peer to peer. And that's the beauty of this network, is that every transaction is unique, every transaction is verifiable. And I made reference and I waved my hands around, we talked about those sort of 10 hypothetical computers. I think that if you think of the network with 10, it's a lot easier than sort of the tens of thousands, if not millions, of sort of entities that are supporting this. We have publicly traded companies, Marathon, Hut 8, Riot, a number of different large private entities that are in the practice of mining Bitcoin. And I think that when you talk about this network of computational power, there is sort of a collection of the masses. And Conrad, you and I chatted briefly prior to this, where there has been large quantities of computational power that has accumulated. So regardless of if Bitcoin is 115,000 as measured in USD or 85,000 as measured in USD, one thing that you cannot argue with is the technological capability of this network. And I think that if we were to compare it to Ethereum, for example, Ethereum in itself is also a network. Ether is a token or a coin that trades on the Ethereum network. Bitcoin is kind of one directional in a sense that it's just Bitcoin and it's just the Bitcoin network. Ethereum and the Ethereum network, or Ether and the Ethereum network, offers opportunity for a number of different decentralized applications and sort of end use cases on their network. Bitcoin is just Bitcoin. The Bitcoin network is just the Bitcoin network. And I use two ways to kind of describe this. The one is sort of the commonly used adage that one Bitcoin equals one Bitcoin. In 5 years or 10 years, that will still hold true. Like it's almost like the law of physics. One Bitcoin will be one Bitcoin. What the US dollar will be worth and how many of those dollars will be printed in the next decade, that we cannot control for. So similar to gold, of course, we're having to drive deeper and deeper into the ground as this resource becomes more finite. We're not just finding nuggets the size of your fist in the northern parts of our country, if you would. Like we would have been a couple hundred years ago. Mind you, gold, we can study and look at thousands of years of data and how it's been treated and assess it as a phenomenon. Bitcoin is only 16 years old. I think that if you draw comparisons between the two, we had that chart up earlier that showed that Bitcoin checks a lot more boxes. I think that as you look at this and you compare the two, it's not ironic that we refer to this as mining. It's not ironic that we refer to Bitcoin specifically as having a scarcity element. It will become harder and harder. And one thing that we want to touch on is a concept called halving. With respect to Bitcoin, To further understand this network or the blockchain network and all the participants that support it, they're not supporting it for no reason. They're profit oriented. Every 10 minutes or 6 times per hour, 72 times per 12 hours, or 144 times in a day, there is something called a block reward. That block reward, forgive me, it either started at 50 or 25 some years ago, but it's been cut in half. So it went from 50 to 25 to 12 and a half to 6 and a quarter to 3 and an eighth, which is where we sit here today. And I think if you think about that block reward, that is the reward for the miner with the computational power that's supporting this network that correctly solves the next chain of that of supporting the blockchain, if you would. And as a result of doing so, their efforts, their computational power, their real estate footprint, and their energy bill are compensated for. And I think that with these halvings occurring, I talked about every 10 minutes, 6 times an hour, 72 per 12, and 144 per day. If we extrapolate that out, every 210,000 blocks, and again, this is hard-coded into Bitcoin protocol, every 210,000 blocks, which equates to roughly every 4 years, there's something what we call a halving event. So a halving event most recently happened in April of 2024. What a halving event stands to do is reduce the block reward by half for those that support the network. So all things being equal, in order for the next 4 years from a revenue profile for mining Bitcoin and supporting the network to look similar to the last 4 years, the value of Bitcoin needs to essentially double, again, in a vacuum math, for the revenue profile of these miners to look the same. So what's going to happen is if revenue goes down because the block reward diminishes by half, you're going to see people leaving the space. What happens if there's less computational power? Well, we look at things like hash rate and sort of the complexity of the network and ability to sort of continue to solve problems. And again, nothing is changing about this protocol. You need a majority consensus amongst participants, which you can't use the word never, but it's highly unfeasible for this consensus to be arrived at or reached to change any of these characteristics that we talked about. So I did my best to not make this super abstract, and I'm kind of listening to myself talk here. Some of this is not everyday stuff. Do you want to clarify or double click on any of that, Conrad?
So I'd like maybe just if we just roll it back here, because again, I realize in speaking with the group that we have assembled as the audience, there are different levels of knowledge here. So really what I hear you saying, Brennan, is that at a very basic level, a blockchain is an immutable ledger or record of transactions, and those transactions could be different types of transactions. They could be the trading of Bitcoin, or they could be the execution of another function on a different type of ledger like Ethereum. But at the end of the day, what you have is a network of computing power that is creating an immutable ledger. And and so that would and there are different types of ledgers, right? They go by, again, different names like Ethereum or Solana or Ripple or Bitcoin for that example, and they fulfill different purposes. And at a fund, there are lots of different purposes. I think you made reference to certain types of transactions. It could be if I do A, you will do B. That could exist on one type of blockchain, or if we're talking about Bitcoin, it would just be me transferring you Bitcoin. That is now in an immutable ledger. I can't come around and say, hey, you stole from me, because you have a record of it being done voluntarily. That's immutable. And so to maintain this unalterable ledger, you also have incentives that are built into these structures, right? Now, and you talked about Bitcoin mining, which is essentially the idea of extracting Bitcoin out of the digital universe, or it's out of the earth, so to speak, if you want to think of it like mining gold.
The unmined
and
balance.
That's you're mining it out of the you're mining it out of the network, and that supply is limited, right? And so that would of course imply that over time, as demand grows for a limited resource or a limited for a limited store of value, or the ability to use a token, that would increase the value of it. So that's and so did I capture that properly, Brennan, or am I?
You really did. I hope that you brought some clarity to the sort of the long-winded approach with additional sort of contextual examples that I provided.
Right.
So that was a great summary.
These are all good things. Like it is important to understand that like scarcity has an important role in creating value in Bitcoin, right? It's a network effect and it's scarcity. And without getting into projections or anything like that, this is how some forecasters will look at Bitcoin and say, look, there's substantial real room for appreciation ahead. And there are of course skeptics, but we want to acknowledge that this is sort of where the thought lines are. Earlier in the presentation, and I have a couple questions about this sitting in the Q&A. So we talked about a couple of things. You mentioned something called a stable coin, and you as well as a treasury company. You may see them, so they're participants, you may see them out there under the name of digital asset treasury or DAT, and a stable coin. Could you just maybe give us a quick rundown on what is a stable coin and basically where are we at now in terms of legislation and how those things are regulated? So if I go out and buy a stable coin, what am I going to get?
Yeah, so by buying a stable coin right now at present, there's USDC, that's Circle Internet, which IPO'd a number of weeks or months back. There is USDT, that's by Tether. So there's probably 260 to 300 billion in stablecoin value out there today, with the previously existing company Tether, who is not US based, representing the bulk of that balance. I think when you get a stablecoin, what is this? A stablecoin is something that is pegged to the US dollar that is adopting digital asset technology to provide liquidity and a means to transact that is not through conventional means. So,
right, so again, I could, for instance, buy your jacket off of you on a blockchain, in exchange for USDC, treasury, a stable coin amount.
And I don't need to put it in the mail. You have rightful ownership of that. And there is, in the cases of this, is backing the value of a stable coin are US treasuries and verifying it. These are fully auditable by US entities in the case of Circle or USDC. So essentially what it's doing is it's providing a means internationally for large institutions. I think there seems to be a misconception that there's like a use case to like buy a coffee and a sandwich with stable coins. And I think that like while that might be like factually correct, if we look at the total volume of transactions that is occurring, it is by institutional counterparts that are otherwise ditching previous outdated historic means of settling transactions to a more forward-looking and relevant, quick way of transacting. Like on a global scale, the system in which we're using to net settle, I can't say it hasn't changed at all, but like it hasn't changed meaningfully in light of the leaps and bounds of technological innovation we've experienced over the last 10, 20, 30 years. So right. Stablecoins are...
For instance, Brendan, if I'm the Canada Pension Plan and I'm buying a group of bonds from the New York State Teachers Pension Plan, we may choose to settle in a certain number of stable coins because it just fits their needs and we can give them the US dollars they need in exchange for the bonds they're selling.
It's quite possible. And I think that back to sort of the Ethereum, Solana, XRPs, and Bitcoins of the world, having this growth in the magnitude of what are stable coins at say 300 billion at present, having the growth and the potential forward trajectory of putting real dollars in the digital asset ecospace, it doesn't necessarily have to be in any of those four that I just listed, Bitcoin, Ethereum, Solana, or XRP, having the magnitude of dollars in a digital ecospace that is adjacent to those four digital assets is, all things being even, introducing a new supply or new potential kind of leakage of demand into sort of those more traditional digital stores of value. So I think that the innovations and the efficiencies that can be brought about with stablecoins are huge. I read just the other day that USDT or Tether was, if assessed relative to other nations, would have been the 18th largest holder of US treasuries globally. So again, this is a relatively new technology that is now the 18th largest holder of US treasuries. So I think that, like, get the popcorn out. Like, we're kind of sitting back, we're watching this unfold, and this is sort of history with respect to, I don't know, currency, technology, and the way we transact globally changing for the better, I think.
All right. You know what? I've got a few other questions that filtered in. There's one that arrived very early, which you did reference already. But there's actually one question here about security in the Bitcoin network and blockchains in general. I think it would go out to. So thank you for that. You know who you are. Thank you so much for asking this question. It is important. Basically, the question, I'll just read straight off the email saying, why are you folks convinced the protected Bitcoin system could never be hacked or infiltrated or illegally modified? All tech security is ultimately vulnerable, isn't it? So how is for instance, the Bitcoin network secure? How does it really unalterable?
We can't use the word never. We can't use the word impossible. It is alterable. I think that we need to assess the likelihood or the feasibility of that. I think that the big one, I don't know, I don't think it was said within the question specifically, but quantum computing. The existence of a computer that is strong enough and or stronger than anything we have or have seen today in order to sort of crack the code and threaten the validity and the immutability of this network. That is a real risk. But again, we just talked about a whole bunch of I guess, pros. I think it's fair that we address the cons. I think that when you're talking about digital assets or the Bitcoin and blockchain network in particular, we need more than 50%. We need 51% consensus amongst the network to make changes. So if one computer were to threaten or provide a sense of vulnerability, that's great. This is verifiable. But with that said, I think that you would need massive collaboration of dollars, or say it's a different like capital and power to possess that computer and want to use it for harm to the network. I mean, if I think about growing up, it was like, don't put your credit card information online because that makes you vulnerable. I think that if we look forward today, someone can still steal my credit card information very easily in many different ways. In fact, it happens all the time. But does it happen to a degree that makes society question putting their credit card online? And I think the answer is no, right? Like there's a lot of angles to be had with respect to the vulnerability of the network. And I don't dismiss them, but I would like to think that like we would literally have to get Alphabet, Meta, and NVIDIA to collectively combine their efforts from a computational and dollars supporting the initiative standpoint to take down this network. Either that or you'd need like Russia and China at the same time collectively coming together to say, hey, we want to take this down. You got to think of like resources, motive, and the combination of the two to drive such an action. And I mean, I don't want to get too dark in what we're talking about here, but like things can happen. You can't rule out collective forces doing bad things, but I think that you have to think about like what is the likelihood or the feasibility or the rationalization for such an action.
Right. Well, that's some good perspectives. I mean, because it isn't, I mean, nothing is all one way. And I think we've always been very clear here with Kluge Wealth Advisory Group that, look, this is why digital assets at this point are still a small portion of portfolio construction, because there are rewards very clearly. We've all seen them, but there's also risks, right? You know, volatility being one of them. Also, of course, network integrity. Volatility. I mean, the way to deal with that obviously is patience. But in terms of those larger network risks, I mean, they are very, very remote, but not impossible. We always want to be completely upfront and saying, look, this could happen. It's possible. It's just not very probable. But at the same time, nothing's perfect. We did have a couple questions though as well, just on obviously Bitcoin specifically, but all blockchain technology is dependent on electricity. And just a couple of questions here on what would, say, for instance, happen to the price of Bitcoin if there were to be a dramatic increase in the price of electricity because of increased demand from not only the blockchain technology, but also as well as twinning with the increased demand that we're seeing from artificial intelligence.
I think you'd see a positive relationship is the quick and clean answer. You see a positive relationship between higher energy equals higher Bitcoin, but it's not going to be positive with a correlation of 1.0. There will obviously be events and different happenings in between that that will sort of interfere with that relationship. But I think if you see materially higher energy prices, assuming it just doesn't sort of go threefold overnight, if you see energy costs growing over time, the cost to support that network, the cost to mine are going to go up. And what you are going to see is if the profitability of entities that are supporting the network is threatened, less and less will continue to exist, or simply people will drop off. And if all things equal, that needs to equal higher price to justify not a greater block reward as far as quantity of Bitcoin. The three and an eighth will be 3 1/8 as far as what's rewarded. But I think the value as translated to fiat currencies, whether you're mining in the US, Kazakhstan, or Canada for that matter. I say Kazakhstan because that's a popular mining location due to a number of different things, access to energy, regulation, etc. I think that it is a free-flowing supply and demand type economy where resources will sort of be additive when it's profitable to do so, and they will back themselves out when it's not. So that would be how I think about the energy side of things.
Right. That's, so there's obviously some relationship. Miners have to get paid. Bitcoin prices have to go up in order for them to do so. And if it's cost more the electricity costs more, ultimately the price of Bitcoin needs to be higher to incent the mining so that you're generating the result, which is the Bitcoin. Yes. So another quick question here we have, which is interesting. I like this question a lot. So thank you to the person that sent this here. Basically, I'm just reading the question out here. It says, a Bitcoin may have a finite supply, but is there not an infinite supply of alternative coins? What gives value to Bitcoin versus alternative coins, right? Couldn't you just make a thing called Bitcoin 2 and then, have it, there are other networks with a cap of 21 million coins. They all do, they have other uses. Why are we talking about Bitcoin here and not not an alternative currency? And I could just naming one off the top of my head, Tau, right? Why is that? Why is Bitcoin 100,000 and not an also ran weird? I shouldn't say weird, but just very, very tertiary token.
I think a couple things come to mind. If I were to tell you that there's a Rolex 2.0 and it's half the price, or if I were to tell you there's a Ferrari 2.0, it has a smaller engine but it's half the price. Or similarly, there are other coins out there. They are not Bitcoin. And I think that if we look at trading cards, artwork, vintages of alcohol, a number of different things that represent a store of value from one person to a next. I mean, 750 milliliters of Napa Valley Cab Sav is the same 750 mils as something that is made in BC, Alberta, or in Ontario. Why are they given different stores of value? They are the same liquid quantity of an item. And I think that would go back to there are tens of thousands of alt or meme coins out there. And I would think about, or I would just share with the group, that if there's about a 4 trillion, and again, moving target, about a 4 trillion market cap of digital assets today, we call Bitcoin 2, or about half of it. We call Ethereum, Solana, XRP, or Ripple about the other quarter. And then that last quarter, or that last billion, I kind of call that the Wild West. That is a spot where it is ripe with speculation. There's a ton of innovation. There could be some great things to come out of that corner, but that is not where I'm investing, and that's not where I'm looking to provide an allocation from the lens in which we are building portfolios. Yes, great things can come out of that quarter, but it is the Wild West. I would say you have far lesser odds than walking into your local casino. And I think that's why when we talk about the digital asset space, talking about the 50% that is Bitcoin, or sort of the other quarter, or the billion that is XRP, Solana, and Ethereum, we have a certain level of conviction in the staying power and validity of those names and the technological value proposition that they provide. The same can't be said for the tens of thousands of other components at this point.
Right. Well, that's a good perspective. Thank you. Turning really quickly here to, and I recognize we're going to butt up against time, so if anyone does have any questions, please send them in. We got another one here just on, obviously we see names like MicroStrategy in the world, which is a very, very large, what we call digital asset treasury. Can you just give us a very, at a very basic level, what is a digital asset treasury? And why would you, for instance, see investors buy that versus going and buying Bitcoin itself, for instance?
Yeah, you got to be very careful here. So there's strategy, formerly coined as a MicroStrategy, headed up by Michael Saylor, where essentially he's deployed a number of different financial engineering type techniques to raise large amounts of capital and go out and buy Bitcoin. And in fact, MicroStrategy was at point in time a real company, but it was a point in time where he began accumulating Bitcoin, and that very quickly overshadowed the size of the actual business. And it effectively is a Bitcoin treasury at this point in time. These are things that deploy degrees of leverage. And we need to look at and assess the net asset value of the company's assets relative to the price. So historically, Strategy has traded at a material premium to the net asset value of the underlying components. And as someone who's buying, considering buying, holding, considering selling, you need to be aware of that reality. I draw a parallel to, I believe it's called Meta Planet. It's Japan's equivalent. It trades on different exchanges, but if you look at its price on the Tokyo exchange, you would see that this is down massively. Billions of dollars of capital have been eroded from investors in the last month and several on a year-to-date basis. And if you look at something like Meta Planet, you need to assess that there was a point in time where its price relative to NAV was as high as 8 times. So I really emphasize that while what these groups are doing is a novel approach, we also need to declutter and kind of see through a lot of the noise with respect to its validity as a long-term approach. I think that of the market cap of Strategy, for example, many people would just think, oh, I'm buying Bitcoin exposure through a publicly traded stock. And I think, yes, while that is true, you're also picking up a lot of other baggage and a lot of other exposure to their underlying strategy and how they've raised the capital that maybe you're not quite aware of. So I would just say, like, approach with a degree of caution to that space. Make sure you do your homework. I'm not here to say whether they're bad or good. I might have painted it with a brush that's more one-sided than not. But these things trade with massive volatility and they can have large swings. Like if Bitcoin goes down 10%, you could see the value of Strategy being down 30, 40. That's not unrealistic. They are levered to the price of the underlying in some respects.
Right. Well, we do know and always advise that leverage amplifies both gains and losses. So there's your balanced approach.
Yeah.
Just thinking of just going to quickly check my email here and see if there's anything else that's come through here.
While you're doing that, I'll maybe
that question actually answered another question we had earlier about how would you generate a higher risk Bitcoin strategy? Well, there you go. Digital asset treasuries covers that off.
You can use options, you can use leverage, you can invest in the Treasury Co. The one thing I would say is that in the Fidelity ecosystem, we've had PMs that have shorted Strategy, and we've had PMs that have been long investors in Strategy. Some have done great, some have done okay, others poor at different times. I mean, that's what makes a market, is two sides and two opinions. Even within the Fidelity ecosystem, we've had both sides of that trade.
All right. I think what we'll do is we'll just leave off at this last question here because we are coming up to 45 minutes and we do like to, not test the human attention span or the capacity of the human bladder. So what I wanted to ask was a question saying, okay, so potentially Bitcoin is a store of value. There's obviously a network associated with it. What other use potentially is there for Bitcoin? Are there other uses that can be layered over top of it, or is it just this sort of digital gold?
There are very much use cases. When you have something that's a store of value, you think you're home. You can borrow against it. So there is legislation being passed right now to discuss and introduce the concept of being able to borrow against a pool of assets that are digital in nature. And as legislation and regulation gets put in place, a lot of these capabilities will unfold. And I mean, I'm not in a position where I'm so fortunate to have had this be the case, but if someone has amassed a material amount of capital in Bitcoin or another digital asset from, say, 5 or 10 years ago, they're in a stance where they're like, hey, how do I use this? How do I avoid massive tax on this? Maybe I can borrow against it, incur an interest cost, fund someone else's pocket with that interest cost, but have access to my capital today. I would say that's a use case which we could see more prominent in the pipeline. Beyond that, I do think that sort of we think about developed nations and less developed nations. Think of the hyperinflationary type environments where having a cell phone, and I've brought this up for a third time now, having cell phone and connection to internet allows you to hedge last week's earnings to purchase next week's groceries. I think that's probably the most kind of the best silver lining or most ethical or philanthropic type of use case out of this. If we look at reports from like Visa and sort of other global payment providers, global remittances, if we think about like migrant farm workers sending money back home, They used to have to go and incur a $55 charge at their local sort of provider that would allow them to wire money home. Whether they're sending $350 or $3,500, they were still incurring like a $55 charge. So I think the ability to, through a liquid fashion with simply access to cell phone and internet, there's massive opportunities being opened up on a global scale.
Right. So again, I have seen video, and I'm sure that if any of the attendees here today were to look it up, you can see, somebody, I believe, is El Salvador has adopted Bitcoin as a actual like a legal tender, right?
Yes.
If you go into a McDonald's in El Salvador, it'll quote you the price in local currency, it'll quote you in USD, it'll quote you in Bitcoin, and you can choose off your phone which one to pay with.
Absolutely. And I think areas of Africa, highly prominent. Anywhere where you've seen double-digit inflation as a part of their culture long-term, if not periods of spikes, Venezuela, triple-digit type inflationary backdrops, I think that there's a massive real-world application in a very good way. We're up here in developed Western world talking about its use case as a store of value in portfolios, which I'll maybe just like layer in my close, Conrad. I want to be very mindful with respect to using ETFs, and kudos to yourself and the team for being an early adopter of FBTC. I really look at ETFs through three lenses: price, brand and reputation, and custody and security. And with FBTC at Fidelity, I really feel like we have a strong value proposition across all three of those pillars. Our goal and our objective on that product is simply to provide investors with exposure through an exchange traded product that accurately tracks the value of Bitcoin. And if we can do that, we've done our job, and we want to keep it as low cost as possible. So I know we've talked about a lot today. I hope it was beneficial. Thank you very much for having me on, Conrad, and I'll pass it back to you for a close.
All right. Well, thank you very much. I would just say thank you to all the attendees for taking the time from your day to take a look at this. I always want to just leave any communication just by saying, if you have any questions, please reach out. We're here to get the answers if I don't know. Obviously, as you can see, we have great resources with deep knowledge, and great partners for us to turn to when we need to get those answers. So any questions you have, reach out. We're here to get the job done. And with this, I will sign off, and we'll look forward to seeing each and every one of you at reviews, in phone calls, or perhaps at our next webinar. Thanks so much, Brendan, and thank you to all the attendees.